Investing for Beginners 10 Golden Rules for a Successful Portfolio. Written by Jonathan Marlowe. Narrated by Nathan Johnson. Introduction. The power of investing to change your life is truly incredible. Through a rigid plan of even just contributing 10% of earnings per month into an investment fund, it is actually possible for anyone, even on the minimum wage, to become a millionaire. This is not a get-rich-quick guide. Investing takes time, but this book will teach you how to invest wisely so that you can actually make absurd amounts of money over time with very little risk. Over the past 100 years, the annualized return of an S&P 500, including dividends, has been just over 10%. Assuming an average return of 10%, a one-off investment of $30,000 would grow into over $1 million within 37 years. Most of us cannot afford to just invest $30,000 like that. However, a program of monthly contributions combined with the power of compound interest will grow into riches surprisingly quickly. $450 a month in contributions adds up to $2.5 million over a few decades. $250 in contribution a month adds up to $1 million in 45 years. The great thing about compound interest is that it makes your money grow exponentially. We said above that $30,000 will grow into $1 million in just under 37 years. But what if we left the money to compound returns over 45 years instead, at the same 10% annual rate? Then you'd amount over $2,186,000, more than double the result from the same initial investment, just left to compound interest for an extra 8 years. You should now understand the huge potential investing can offer any of us. Do not be disheartened if you invest and the next day the stock market crashes. Over time, your returns will average roughly 10%, going by long-term historical trends for the S&P 500. So it just means the growth over the following years will be higher to return this average. The great investors like Buffett don't try to predict when the next crash or boom will be. They know it's impossible to do so. Over the long term, however, the worst crash will just be a small blip. This is all made possible by the power of compound interest. The most powerful force in the universe is compound interest. Albert Einstein. These returns surprisingly do not come at a high risk either. They come from a simple set it and forget it investing style involving an extremely safe S&P 500 index fund. The possibilities are endless when you combine consistent returns with compound interest. Essentially, a person could go their whole life without keeping up with the stock market and be a multimillionaire when they retire, all by using the tools available to them. Investing. Investing is very different than speculating. Those who buy low, sell high with stocks play a risky game that is usually not any different than gambling. Furthermore, most online traders lose money over time trying to beat the market. Forex trading is the worst offender, usually offering odds worse than casinos. True investing disregards those flashy concepts and rather focuses on the long-term truth of the market, that it will increase slightly over time. A specific type of investment called an index fund takes advantage of that fact and rewards smart investors. With the advent of the internet, many more people are becoming educated and aware of investment opportunities in which they can make money. After all, having enough money in general is a goal for nearly everybody. Whether it is for retiring comfortably, having an emergency fund for unexpected events, or achieving financial independence to work less, money is what we need and seek to earn. However, only a select few individuals are born into wealth. Nearly all families must work full-time jobs to pay for the necessities and also enjoyable items such as televisions, gadgets, and new cars. Saving for the future is a difficult task for families like this. And without saving money, there will be none when it is needed most, such as for retirement, children's education, or unforeseen emergencies. Despite this fact, there still exists a way for modest income earners to make their riches while not changing their job, lifestyle, or living situation. Earning extra money through smart investing is a very valuable option for any person, whether they currently make only a living wage or whether they already have a six-figure salary. For families with a modest income range, securing a large sum of money seems very out of reach, but investing serves as a great equalizer that can help anyone amass great wealth. Investing your money is one of the most worthwhile things you can do in your life, and everybody should be letting their money work for them by investing it. This book serves as an introduction to investing. It will explain key concepts behind intelligently allocating savings and also give advice on recommended courses of action for every type of person. Investing is not a get rich quick scheme, nor does this book seek to teach you how to make a quick buck. Rather, investing takes time to work fully, but when investing works as magic, it surely seems like a miracle. Moreover, this book recommends a method of investing that takes very little amount of effort. Over a long period of time, this minimal effort method of investing results in a fortune, all thanks to the powerful force of compound interest. By reading this book, you're abandoning the idea that you can invest one day and return the next a millionaire. Instead, you will equip yourself with the knowledge necessary to make long term financial decisions regarding your savings that will make you into a millionaire with time. This book is for those that have no prior experience in investing, and additionally, no prior knowledge is necessary to start learning. It is important to note that you will have to understand how investing works before you begin to participate, and thus you should read this book entirely before following any advice contained therein. Even if you have a small amount of previous knowledge, strengthening the foundation is an intelligent choice. And finally, after explaining how stocks, bonds, funds, and other parts of the market work, we will explain why index funds are the smartest choice for any investor and how they can make you money through a lazy investment style. Read on and discover how to make your money work for you. Investing basics. Investing is the act of putting forth money for economic ventures in the hope of gaining additional currency back. Despite the similarities, investing is not nearly the same as gambling, for investors can use science and mathematics to increase their odds of a fair return, while gambling remains randomized. Investors do take a small amount of money and turn it into something greater, but that is only achievable through informed decisions and sound planning. People invest money to make more money. The goal of investors is to have enough money in their lives, and with today's internet connected to the trading world, anybody can start investing. The downside to this is that a plethora of information about investing exists, with barely any of it having the beginner's best interest in mind. Just by reading this book, you're already gaining an advantage over many, and it starts with learning the basics presented here. Stocks. Investing is done in many ways, with the classic view of investing involving the stock market. The stock market is an economic concept where businesses sell portions of their assets in the form of stocks. Investors buy stocks, thereby lending their money to the publicly held company. The company uses the money to expand their business and hopefully grow to make more money, in which case the stocks are worth more. Investors make their money back by selling the stocks at a higher price, making a profit. Individual stock trading is a high risk method of investing where fortunes are made and lost in a short amount of time. For beginners and veteran investors alike, the stock market is not a good choice for making money because of its volatile nature and instability relative to other investing methods. Nonetheless, stock trading remains very popular due to success stories in popular media. Stocks are traded through a stockbroker, which is a person who actually purchases and sells stocks for you. Discount stockbrokers are typically companies that receive your order request and purchase stocks on your behalf for a fee without providing advice or individualized service. Expensive all in one stockbrokers do the opposite, as they learn about your goals and status to help you make most of your money. The stockbroker purchases stock for you, and you can make money in two different ways. First, selling your stocks as they increase in value returns a modest profit. The other way to earn money on stocks is through receiving dividends, or regular payments based on the value of the stock. Because owning a stock means owning part of a company, oftentimes you're entitled to earnings from the company, and those come in the form of dividends. When companies perform well, their stock price rises, meaning dividends increase. Alternatively, you can sell the stock for a larger amount than you paid for it. It is because of the rapidly changing stock prices that individual stock trading can become risky, but with a chance for high rewards. Bonds. Similar to stocks, bonds are temporary loans requested by a company or similar entity. When that company needs to fund a new project or addition but does not have the money, they begin selling bonds. Investors loan their money to the company with the stipulation that they receive it back in a set amount of time with gained interest. Bonds are safer than stocks because the money will be paid back so long as the company still exists at the end of the loan period. Risk comes from the possibility that the company becomes bankrupt and unable to pay back the loans, in which case the investor loses their investment. It is a rare event, though, which is why bonds are a stable consideration for investing money. Bonds can come from companies, governments, towns, cities, and more. Higher interest rates are wanted by the investor, but often an indicator of a riskier investment. These high risk bonds are called junk bonds because they have the possibility of turning into junk. Governments and other stable organizations will have a lower interest rate, but generally guaranteed returns, a much safer choice. Investors can balance their appetite for risk and reward based on the entity for which they purchased their bond. The initial investment is cashed in after a predetermined amount of time, known as bond maturity, that ranges from a year to many decades. Because of the general stability of bonds as an investment type, these are highly recommended to supplement an investment portfolio. For your age and years, you should have that percentage for your savings and bonds. A 25-year-old will take more risk by having fewer bonds, but as they get older, they turn their high risk investments into considerable bonds, thereby decreasing their risk as they get closer to needing their investment money for retiring. Individuals can typically buy bonds on their own directly from the organization issuing them. As an example, citizens of the U.S. can buy Treasury bonds through the government website. Consider investing in bonds as a safer alternative to stocks. Certificate of deposit. CDs, also known as certificate of deposits, are bank given certificates proving a deposit of funds. They have a slightly higher interest rate than a savings or checking account, and they are considered extremely safe as an investment. However, because of the virtually non existent risk, the interest is very small. Some CD types have maturity dates, which are dates from which the money can be withdrawn. Leading up to the maturity date, the CD will gain interest at a fixed determined rate until it is time to collect the money. Overall, CDs are not the best for making money, but they are certainly safe for ensuring money stays untouched, secure, and without loss. Mutual funds. Somewhat of a middle ground between stocks and bonds are mutual funds. Mutual funds are contributions made by different people pooled together in a single investment that is used to buy a mix of stocks and bonds. They are highly recommended for those that wish for a more passive style of investing, also known as the set it and forget it. Mutual funds actually have plenty of options ranging in risk. Person can choose to invest in one that focuses more on risky stocks, or that person can buy one that is mostly bonds. The main advantage of a mutual fund is the ease of entering the market. Typically, the investor pays a lump sum of money to a fund, and the money manager of that fund decides where to invest based on the risk for that type of fund. The fund manager makes decisions on when to buy and sell to maximize returns, and they take a portion of the earnings as payment. Some mutual funds can carry high fees, so it is always recommended to understand how the initial payment will be used. Diversification is made easy with mutual funds, as money is spread out over many different types of stocks and bonds. If one investment does not return quite well as expected, the other can pick up the slack and minimize the damage. There are various types of mutual funds, such as equity, index, money market, balanced, fixed income, and fund of funds. They're explained briefly here. Equity funds are for risk taking investors wishing to invest in stocks. Index funds follow market indexes, meaning money is invested in the broad spectrum of companies that a market index can cover. Popular ones include the top 500 U.S. companies, for instance. Index funds are an often overlooked investment opportunity that will be discussed later. Money market funds have a focus on very safe investments such as government bonds and CDs. Balanced funds hold a split amount of risky and safe investments, such as 60% bonds and 40% stocks, in order to make money while having a safe net for unexpected market failures. Fixed income funds invest money in sources that provide a steady stream of interest at a fixed rate. These funds will continuously return money at a slight risk due to the risky nature of junk bonds. Fund of funds invest participants' money in other funds. Consider it a meta-balanced fund, for it spreads money over many funds to maximize returns. Instant diversification can be had through a fund of fund. An ETF, or exchange traded fund, is somewhat like a mutual fund that trades as though it were a stock. These types of investments are not very popular, most likely because they require a broker. For most people, they are not a sound investment, but they do provide benefits for those wishing to purchase a large investment and hold it for a long time. Mutual funds are a highly diverse but popular type of investment. They vary widely between having high fees and management payments, but some have minuscule fees and management payments. For many people, a mutual fund is the only investment they ever need to make, as they can consist of a mix of the most popular types of other investments through a single investment input. Annuities. An annuity is a type of investment involving an insurance company. An initial lump sum investment is made, or funding is done as a monthly investment, and the investment contributes to the annuity fund. The insurance company invests this money and agrees to return the investment plus interest at a later date, often during retirement as a monthly payment. The similarities to Social Security can be seen, but annuities are entirely optional. Interest gained is usually nothing special, and for most people, an annuity isn't always the best investment. However, finding a decent contract with low fees and a satisfiable payout could be an attractive offer provided you study it and understand where your money is going. More concepts. Investing is not quite as simple as choosing a fund and collecting extra money, though. There are a few other concepts that must be taken into account when calculating potential risk and returns. Taxes. Firstly, money earned is subject to tax in the United States. This applies to income through working a job, just as it does through income coming from interest on investments. Taxes are a wide and difficult subject to discuss concerning investments, and furthermore, the exact rates and laws are always changing, so this book will not claim to have a masterful understanding of them. However, we will provide sound general advice on taxes charged to your interest income. Every type of investment has a different tax rate. Some are more tax efficient, while others have outstanding tax rates. Typically, bonds are a highly taxed investment, while common stocks are normally taxed. As a U.S. citizen, we can open various tax deferred accounts to handle our investments, and these accounts have reduced or eliminated tax rates. Although only so many funds can be added yearly to these tax deferred accounts, they usually do not charge tax at all until the money is withdrawn. Compare this to normal accounts for which investments that return dividends can be taxed every single month. Allocating investments to minimize taxes can help reduce the amount that you're taxed. Generally, you should be putting highly taxed investments such as dividend paying ventures, bonds, and junk bonds into tax deferred accounts such as Roth IRAs and 401k accounts. Lower taxed accounts are only taxed lower because they have a maximum contribution per year. For IRAs, this amount hovers around $5,000. As you will probably fill this amount up, it should be reserved for the highly taxed investments only. Investments with a lower tax rate, such as regular stocks and index stocks, can be put into normal accounts as to not fill the tax deferred account needlessly. Overall taxes represent a high fee on your investment earnings that can and should be minimized as much as possible. While this book might not recommend active traders, brokers, and money managers quite as much, it never hurts to get a tax professional's opinion on your investing future. Before setting up any investment accounts, precautions should be put in place to reduce the amount of tax you have to pay total, or at least put it off until you have enough money upon interest withdrawal. Inflation. What our grandparents could buy for a single dollar today, we can never dream of owning for the same price. Just a trip to the grocery store may cost $200 today, but previous generations could pick up the same amount for only $20. Due to inflation, the general price of everything we buy increases yearly in such a way that reduces our money's potential. At a variable rate ranging from 2 to 5%, the price of everything goes up. In many aspects of our income, inflation is combated through raises and other increases in salaries. Prices goes up, but so does the amount we earn. This is why that buggy of groceries isn't $20 anymore, because many of us are making well over $20 an hour, where our predecessors were making $4 or $5 an hour. So although prices go up, so does the money that we earn. Sadly, though, this does not apply to investments in the same way. An investment of $1,000 would have been substantial in the 40s and 50s, and that $1,000 could have potentially grown to hundreds of thousands. In 1940s money, $1 million would be a small fortune. However, inflation takes its toll, so if that $1 million were cash now, it would not nearly be as substantial as it seemed decades ago. Money made from interest on our investments is not always protected from inflation, and so the percentage should be subtracted from annual earnings. An 8% return will certainly give money through interest, but accounting for inflation, that percentage is probably close to 5% or so. There are very few things that can be done to minimize the effects of inflation on our assets. A few specific investments, such as Treasury securities, specifically account for inflation and add the percentage to the interest return annually. However, these funds are usually low yield and not very attractive for generating a lot of money. Another way to protect against inflation is to deal with it by choosing a long term investment that can take the hit of inflation. Just as in the example above, an 8% return will indeed make money, even though the real rate is somewhere lower. Honestly, inflation cannot be controlled, only accounted for, and you should take it into account for any investment that spans many years and any that will definitely feel the effects of time. Diversification. Explained in passing previously, diversification is an important investing concept that is repeatedly stressed by just about everyone. Your many investments are considered a portfolio of sorts, or a list where all your money is tied up. The portfolio includes investments of all types, such as stocks, bonds, savings, etc., as well as the general risk and returns of each investment. At a glance, you can see that you have a risky stock worth $10,000 and a safe bond worth $20,000, and you can add everything up to see the total funds and holdings. How useful your portfolio is at making money depends on how risky it is. As we've learned, safe investments return a steady stream of small gains, while precarious investment choices have the possibility of very high or very low returns. Risk should always be balanced with conservatism, and this is what a diverse portfolio aims to include. Diversity leaves room for nice gains, such as those earned from high yield, chancy sources, but it also has a safety net in case the riskier options do not earn as much. Having lots of different investments in plenty of places means that if any one of them begins to do poorly, the others will make up for the loss. A cardinal sin of investing involves selling on impulse, and those without a diverse portfolio would undoubtedly want to get rid of their underperforming options at a loss before it leads to a greater loss. Many financial experts will explain that losses are probably temporary and the investment could come back stronger than ever. But without a diverse portfolio, the unsavvy investor almost has no choice but to take the hit and sell. Furthermore, a diverse portfolio must also be invested in multiple different industries. This is because if you only had been investing in oil companies, bonds, stocks, mutual funds, etc., when they have a bad year, the stocks will all decrease. Without multiple investments in other areas, the seemingly diverse portfolio will decrease in value. So, conclusively, a diverse portfolio includes multiple different types of investments spanning a variety of industries. To diversify, you need to be paying careful attention to the types of investments you are purchasing. For many people, this is not a viable option because of time or interest constraints. Remember, though, that mutual funds are an easy way to diversify by making the money manager choose the exact investments. A nice balanced mutual fund will make it easy for you. You only deposit your investment in one place, but the money manager puts a decent amount into a variety of markets to give a safe and diverse return. Lastly, sometimes the market changes as a whole, and the previously well performing portfolio is no longer yielding expected returns. This situation calls for a rebalancing, which is the shifting of investments to suit the market better. It is common practice to review long term investments yearly and make changes should they apply. Beginning to invest, the first steps. Now that you have a basic grasp of the fundamentals and terminology of investing, it is time to prepare yourself economically. Investing before you are ready to shoulder the weight can be detrimental in the long run. You should have a clean slate and be ready to begin investing with a solid foundation. Debt. First, you should not owe any significant debt. Credit cards and loans can have an interest rate reaching close to 25%, an outlandish amount considering an investor would be grateful to have even a 10% return. Every time this interest is compounded, you owe more and more money to the credit companies that you must pay. Many individuals wish to invest to obtain extra money that can help reduce the amount of debt they owe. However, the high interest debt, such as the ones listed above, can often outmatch any investment you make, making your net return in the negatives overall. Before starting to invest, pay off as much of the debt as you can. Even consider paying off the debt a suitable starting investment, because if you pay $10,000 now and have $5,000 more at the end of the year because of it, you have effectively gained a substantial return of 50%. It is understandable that paying off debt is often difficult, especially when there are high amounts to it with a higher interest rate. The amazing concept of compound interest actually works against us. The debt becomes larger over time, and the minimum payments often decrease the principal very little. A loan that should theoretically only take 5 years to pay off might take 10 or more with a high interest rate. Minimizing your debt while caught in this cycle is difficult, but entirely doable. Consider transferring the balance to a newer, lower rate card so it does not gain interest. Many cards have introductory periods without interest, such as Chase Slate Card, and they are fantastic for buying yourself an extra year interest free to pay off the balance. Spread your balance among your cards so the high interest does not hit the higher amounts, making the problem worse. Another lowering method involves taking out a loan or other form of credit that has a lower interest rate and using that money to pay off the credit cards. And finally, stop using the cards until the balance amounts are manageable. As previously stated, the best first investment is eliminating the 24.99% APR balance on your cards. Having the right mindset. Investing requires that part of your paycheck never be used for anything other than investing. As many individuals are living paycheck to paycheck now, they will never have the funds necessary to improve their current situation through investing. Consider taking money out of your check as it is initially deposited. If the money isn't sitting in your checking account, you may be less inclined to spend it. Wealth is a measure of your assets and how much money they make for you. This is not the same as income, which is a measure of how much money you bring in every paycheck. A person can have one that is high, but one that is low. As an example, consider a celebrity making millions of dollars per movie. Their income is high, but if they are not making smart investments and blowing their revenue stream on frivolous purchases such as expensive cars, their wealth will be very low. Similarly, consider a man who works a simple $50,000 a year job their entire life. If they max out their investment opportunities every year, they can retire with millions in the bank. This person's income is low, but their wealth is high. A smart investor can be from any measure of income, so long as they are dedicated to improving their wealth with the money they earn. A bin man can be a bin man their entire life, but with proper investment knowledge, they can retire comfortably. Obtaining the right mindset means leaving behind any notions of using money for status symbols or worthless purchases. In addition to paying off outstanding debts, the mindset switch can be made through a conscious decision to save money and purchase assets instead of liabilities. Consider every purchase that you make and keep a log of where your money goes every paycheck. Reduce the amount you spend by eliminating what you do not need or what you can do at home to save money. Taking a lunch to work can save hundreds of dollars every month, which will be a fantastic investment contribution amount. Put aside this saved money for use elsewhere, such as a savings account or investments. Lower income families can enter the right mindset as well. Although some individuals from low income families are only poorer because of circumstance, many still have less money because of frivolous purchases. This group, more than any other, needs to understand where their money is going and how to better allocate it. Sometimes an additional investment is needed, such as a college degree, to improve the income of a household. Debt is bad, but not all debt is a poor choice. Choosing to get a college degree can increase income very much, and it is highly recommended that most people go down that path. Alternatively, many trades pay exceptionally well, some even more than college graduate positions. Finding a job that provides as much income as possible can help improve the living situation of poorer households, which enable them to start building wealth through investing. Getting a second job or a side job business is certainly a lot of work, but almost all of the money coming from it is extra money that can be invested to multiply it many times over. If you have the time and resources, consider getting alternative streams of income. There are various ventures that allow passive income, which is income that comes even after the job is done. Writing ebooks, renting out houses, starting a blog, or even making YouTube videos are all activities that can have a possibility to earn you money over time. Although the setup time and effort is high, most of the passive income strategies can pay you long after the initial effort. Conclusively, before you begin to invest, you must enter the right mindset. This includes migrating yourself from that paycheck to paycheck lifestyle and putting your earnings into investing. You might have to cut out frivolous spending, or you might have to improve your primary income source to do so, but the benefits gained from investing far outweigh the total work you will be putting in. Deciding your investing style. With the ridiculous number of investment options, you might wonder which one is the correct choice. The answer is that there is no correct choice for everybody because everybody's priorities lie in different places. Deciding your unique investment style is part of the challenge of investing. You must choose which investments to add to your portfolio, considering the risk and reward profiles of each. Younger investors often choose riskier options because of the sheer amount of time there is to invest money. If one investment goes wrong, they believe there is enough time to earn the money back and try again. Older individuals tend to buy more conservative investments, such as bonds, because of the urgency of which they need to get guaranteed returns. Because most 40 and 50-year-olds know they are retiring soon, they would hate having their money disappear because of a risky investment. So the older investors will play it safe and get less money in return. The standards above are essentially stereotypes of two large groups, and you have no obligation to follow them. As a younger person, you might understand that slow and steady wins the race for investments. So you might invest in long term investments such as index funds or fund of funds. Or possibly as an older investor, you could have a large investment built up that you feel comfortable investing dangerously in the chance of doubling your fortune. Ultimately, the investment style you choose will determine the kind of returns you can expect. But once again, there is no right choice for anybody because both main methods of investing have a decent chance of returning a lot of money. Due to lack of experience, you could have no clue which investment style is right for you. But if you continue researching and reading through this book, one will probably seem right for you and your goals. Creating an investment plan. The investment plan is a clearly defined procedure that you create involving your policies toward investing. The investment plan ties in with your investing style to list out your various goals and how you will achieve them. Also, it has your personal rules on how to act in certain market situations. As an example, you should create an investment plan that states you will buy mostly bonds and a few stocks to fill your portfolio. Furthermore, if the market turns bad, your plan might specifically state to ride out the turbulence instead of quickly selling. Having your plan and course of action in writing actually helps you stay true to your goals, meaning an emotional mistake is far less likely to occur, and your long term ambitions will not falter. Building an emergency fund. Accidents, unexpected events, and unforeseen emergencies can usually become a financial burden without notice. Without the necessary funds to cover these events, they can quickly rack up debts with high interest rates. You might have a substantial investment by the time an emergency happens, but most funds are not liquid, and they can carry heavy fees for early withdrawal of funds. Because of this, an emergency fund kept in a readily accessible place, such as a savings account, should be a high priority before beginning to invest. A well stocked emergency fund could save you from a perilous situation, and it will also give you a peace of mind knowing that accidents are covered. A good amount for an emergency fund varies person to person, but in order to account for the worst emergency of a layoff, you should have 6 months' income ready to cover your job search. Supplement your emergency fund with a good health care and insurance plan. With enough careful planning, every malevolent force can be entirely negated and cause you minimal harm. Do not invest without a strong emergency fund because the money can be more easily used without penalty if you have it in bank savings or stuffed in a mattress. Wrapping up basics. By following this chapter's advice, you're preparing yourself for investing with a strong foundation. Too many investors ruin their returns and maximum potential by starting with an uneven base. Problems get in their way, such as debt outpacing their returns or an emergency that causes them to deplete their earnings. But through deliberate preparation, you can have a clean slate through which you can start investing. In review, you will need to eliminate debt. Think with an investor's mindset, choosing a style of investing that suits you best, deciding upon an investment plan, and building an emergency fund to catch unexpected events. How to invest. A keen observer will notice that the book is just about half over, and we are just now getting into how to actually invest. This was a calculated decision made to force you to understand the basics before getting overexcited and rushing in unprepared. If you're still reading this book now, you can congratulate yourself on getting started the correct way. Investing is not a particularly hard activity, so long as you understand how it works. In fact, most investment strategies are set it and forget it type deals where you just keep putting in contributions as your money manager does the hard work for you. But getting to the point where you can relax and know that your money is making you more money requires your full attention, and that is why there is such a lengthy introduction. Investing is done by simply buying the type of investment you want to add to your portfolio. For stocks, some bonds, and other things requiring a broker, you will need to hire one. This can be done physically by going to a financial office, or it can be done online. Typically, online brokerage is less expensive, but it also comes with a less personal touch. It is up to you to decide how involved you need your money to be managed. Note that the more that your portfolio is individually managed, the more you will be charged in fees. Often the fees can cut into your profits seriously, so consider buying investments through discount brokers or investing in assets that are not actively managed. For other types of investments, such as treasury bonds, you purchase assets directly through the organization you wish to invest in. Right on treasurydirect.gov, you can create an account and purchase various types of investments without a broker. Overall, the way that you purchase investments differs as per each type, but the best thing to do is sign up for an all-in-one type investment platform such as Vanguard. Through these services, you can purchase stocks, bonds, mutual funds, and more for a small fee and choose whether it is actively managed or not. Index funds. Possibly the most powerful investment opportunity that anybody can make is investing in a low fee index fund. As we've explained, an index fund is a type of mutual fund that follows stock indexes, which basically means the fund is distributed as a small scale model of the market as a whole. There are plenty of indexes from which index funds emulate, but perhaps the most popular is the S&P 500, a measure of the performance of the top 500 American companies. By distributing a mutual fund between these consistently well-performing companies, modest growth is almost guaranteed. Index funds are so powerful that this book will recommend them as the only main investment you ever need to make to retire with millions, and we will expect why a seemingly average mutual fund almost always performs better than the best financial wizards. How an index fund works. When you buy into the mutual fund, your money goes into a pool of other investors' money. The manager does not have a tough job for index funds because they are so easy, so fees are usually low. The entirety of the mutual fund is split and invested into an index metric. So for the S&P 500, there will be a mix of stocks, bonds, and other investments from those top companies. The ratio in which the investments are made depends on the manager, and some will have different strategies. Ultimately, though, if the index fund follows a certain index, they will perform just about the same. As the indexed companies increase in value, so too does the fund. The growth seen is small compared to high risk stocks, but definitely more stable and predictable. Over time, generally a long period, the interest gains at a steady rate and the principal increases. When you are ready to use your money, you withdraw it from your account. Depending on the account type, you might have to pay taxes, and some funds have a few fees. Finally, though, you get to use your hard earned money earned from the index fund. Why index funds do so well? Index funds work well for a variety of reasons. They really are the perfect storm of investment opportunities combined into one. The following sections seek to explain why they're usually the best investment anybody can make. Consistent returns. The S&P 500 follows the top 500 U.S. companies. These companies are in the top 500 for a reason. They make smart business decisions and continue to grow. Out of the top companies, most of them will continue to grow slightly every year, and this is the fact that the index funds base their investments on. With an average return of 8%, index funds that base themselves on the S&P 500 are a decent investment. Guaranteed return investments such as government bonds have lower returns, and risky assets such as junk bonds and dangerous stocks rarely consistently reach above 10%. Furthermore, investments that have such a high risk also have a chance of losing money, something that the S&P index rarely does. For a long period of time, the index fund has an upwards trend. The average 8% return includes the market dips as seen in 2002 and 2008, and people that had S&P funds throughout those years saw a positive return in the long run. During the same years, investors with high-risk stocks became broke. It is the consistent return of index funds that make them so attractive. Even the best money managers fail to beat the S&P 500. Very few have even seen higher returns, and even those few only beat the index momentarily. The truth is that even the brightest still perform half as well as index funds. Legendary investor Warren Buffett stands behind the S&P 500 by putting it against other investors who always end up short. Compound interest. It pays to go with a safe, relatively boring investment like an index fund because of the magic behind compound interest. For stock owners that buy low, sell high, there isn't much time spent holding each share, so interest never really plays a factor in their earnings. Long-term investors, such as those saving for retirement, have their money tied up in various investments for decades, giving compound interest enough time to increase their initial investment tenfold. Compound interest is a type of interest where earnings through interest are refactored into the principal. If an investment of $1,000 earns $100 of compound interest, then the investment is now $1,100, and the next interest calculation will return $110 instead. Compound interest is a powerful force capable of turning small sums of money extremely large with enough time. An initial principal of $50,000 at 8% annual return will equal over $1 million after 40 years. And that example does not have any additional funding besides the interest earned. Index funds benefit from the compound interest that you can earn over long periods of time. By investing early, the money has more years to compound and grow until the final amount is a nest egg. The steady average return compounds much better than the paltry long-term returns of risky stocks, meaning a person with enough time can invest solely in index funds and make a fortune. Index funds are easy. Because you can buy an index fund and contribute a small monthly amount without a second thought about market value or worrying about stock prices, the index fund is an easy investment. That isn't to say that it's not a good investment, though. Consider contributing a small amount of money a month to an index fund for as long as you can work. The return level is always a positive average, so you do not need to know anything about investing or the current state of the market. All you need to do is continue putting money into that account every month. When you're ready to retire, your money will have worked for you along with interest and put your fortune into the millions, all while you put no further thought into investing. It is such an easy way to make money. It is quite amazing that not many people take advantage of it. An index fund that is not actively managed will flow with the course of the baseline index, and it rewards people for effectively ignoring their investments. While it may seem counterintuitive to everything we have learned about stocks, returns are nearly impossible to beat. Continuing, index funds make diversification easy. Because you are buying investments compared to a wide index of companies, your money is spread over multiple industries in such a way that negatively performing sectors hardly hurt your overall gains. Diversification is important in investing, but a well-chosen index fund takes the difficulty out of doing it yourself. Index funds are low cost. Instead of purchasing individual shares and bonds from companies and indexes, the ease of the mutual fund allows you to purchase your index investment through a single source. This lowers the overall amount of trading fees that must be done to create your portfolio. Also, index funds that are not actively managed will have extremely low fees. Because the money just sits there and works for itself, nothing needs to be actively bought or sold, meaning that the money manager does not need to do a lot of work. Lower fees are always better, and that is why mutual funds are so useful. Taxes are minimized as well with index funds. The nature of returns means that taxes are already minimized, and combining that with an IRA can reduce the taxes even further. The less money the government takes equals the more of your earnings that you actually get to keep. Index overall. For most individuals, index funds are the only investment needed. Provided you have enough time and money to contribute, index funds take care of your money in such a way that you can make millions for retirement without barely any investment knowledge and a minimal amount of work. We will explain the best way to get started buying index funds further later in this book, and you should understand that every person has different investing goals. If you have less time to spare, a low rate index fund might not be the best choice unless you have a substantial sum of money that can gain interest. But the relative ease, low overall fees, and consistent returns of index funds make them nearly unbeatable. How much to invest? Every investor has a different income, and thus some have more to invest in their funds. Thus, the amount that different people contribute to the investment fund can vary widely. To take full advantage of compound interest and other factors, exactly how much should you be investing? As with everything in investing, there is no correct answer for every individual. The common answer is 10% of your income, meaning that every paycheck, 10% of it should be set aside and used only for adding to your portfolio. Aim for this number in general, and it is an easy sum to remember in addition to adding a decent amount every month. However, if you can afford to add more than 10%, it is highly recommended that you do so. Tax-deferred accounts such as 401k and IRAs have a limited amount that they can be put in every year, and maxing out on this amount is a fantastic problem to have. Therefore, investing above and beyond that limit in other accounts is risky because of potential taxes, but well worth it if you can ensure high gains. Refer to the section on taxes to understand how to allocate your funds. Compound interest favors large amounts of money, so putting in extra every month will definitely increase the output of your funds. Every month, add 10% or anything you feel comfortable investing. Purchasing your first index fund. If you've been convinced of the power of index funds, you might be wondering how and where to buy them. This section will walk you through the process with one example. The Vanguard Group is a company that provides access to index funds through their website, https://investor.vanguard.com/corporate-portal/. Started by John C. Bogle in 1975, the company has made a name for itself offering various mutual funds and asset management services. Today, the company manages upward of $3 trillion and is the best source of index funds in the world. It is through their service now that we can still purchase index funds with very low fees. To start with a fund, you will need $3,000. Navigate to Vanguard's personal investment subsite, http://investor.vanguard.com/home/. Click the Open an Account button to load a new page where you can start a new account or transfer a previous account's balance. Confirm that you are creating an account, and it will ask you to create a Vanguard account so you can track progress. You will need to enter your email and a password to create your account. Continue onwards and begin the application process. There are 5 steps to creating your account. The first involves disclosing information about yourself. This includes a social security number, birthday, email, address, and employer information. All of this information is very much necessary to prove your identity and link the account to your citizenship for taxing, income tracking, etc. Second, you establish your funding by linking a bank account through which you can easily fund your index account. Provide the information from the bank that you will be transferring the money from for the investments. To avoid some bank fees, this account should be the same that you get paid through. Thirdly, you will review your application to ensure that all the information is correct. Double check yourself because incorrect information produces unnecessary delays. If your information seems satisfactory, you can submit it with an e-signature. Vanguard will review your application and approve or deny you based on the correctness of the information. After being accepted, step 4 begins where you edit your Vanguard account. Setting up specifics so that you can view your portfolio performance directly online is a handy step that shouldn't be overlooked. Lastly, the final step is to choose a mutual fund to invest in and buy your way in. This is the step where you actually purchase your index fund. You can now search on the site for various investment funds and purchase one that matches your goals. See below for a description of the most popular index funds and what they represent. Various index funds. Choosing an index fund will bring you the benefits and detriments that come with it. Some have higher fees and some have different expense ratios. The index that the fund follows ultimately determines the kind of growth you can expect to see annually. But considering most indexes increase at a standardly average rate, it could just come down to personal preference. Vanguard. The Vanguard 500 Index Fund follows the S&P 500, an index that we have spoken extensively about in this book. It consists of the top 500 U.S. companies and is historically the first index fund ever available to individual investors. This fund is a classic choice and is often a great investment with its low expense ratio, currently 0.16%. It is the fund we recommend, and it costs $3,000 as a starting investment for a general account or as a contribution to an IRA. The yield varies with an average 8% average, meaning the returns are consistently decent. The downside to owning the 500 fund is that you are only investing in American companies, so any foreign gains will not be seen directly at all. Additionally, because the index focuses on the top 500 companies, there is no chance to invest in an upcoming business that has a potential to do very well. Conclusively, choose the Vanguard 500 index as your first choice unless another one catches your eye. A related investment is the Vanguard 500 Index Fund Admiral class, which also follows the S&P 500 index. It has a lower expense ratio, 0.05%, and no transaction fee for a buy-in share. These benefits come about because of the much larger initial investment of $10,000, a price that is well worth the effects. Vanguard Total World Stock Index Fund is a fund focusing on the global market as a whole. It follows an index consisting of markets all around the world in developing countries as well as established markets. By buying into the fund, you are basically owning a share in just about every company in the world. But because of the wide range of investments presented within the fund, often the returns are not as desirable. A consistent 6% can be expected annually, which is not the best, but certainly a good amount. The expense ratio at Vanguard Index Fund, which tracks the FTSE Global All Cap Index, is slightly higher, coming in at 0.25%. But Vanguard's notoriety of low expenses is still seen, as other traders can have fees well into 4%. Because the global market can be considered more stable than individual markets, it is a great long-term choice following the slow and steady mentality. A similar fund to the Total World is the Vanguard FTSE All World ex-US ETF. Just like above, it tracks the global market, but it leaves out the United States. Similar advantages and disadvantages to the above fund are also presented here, but this fund seems to have a much lower return rate, partly due to the exclusion of the U.S. and the global market status in terms of U.S. growth. The fund has very small returns, only suitable for investors that understand how to take advantage of the fund. Finally, Vanguard offers plenty of specialized index funds that follow certain specific markets. As an example, the Vanguard REIT Index Fund invests in an index spanning multiple real estate investments trusts. A fund such as this one will do well if the real estate industry does well as a whole, meaning it is possible to see higher returns than a more diverse fund such as the Vanguard 500. Another, the Vanguard Utility Index Fund, invests in utilities such as electricity, gas, renewables, etc. Yet another is the Vanguard Telecommunications Service Index Fund, which spreads its investments among cell phone providers, internet service providers, and landline businesses. For all of the specialized funds, such as those listed, the potential for growth exists when that sector does well, but the fund could suffer from lack of diversity if the sector does poorly. Albeit, these Vanguard funds actually follow the S&P 500's lead, considering the S&P is made up of many of the companies in the special funds. While you might not want to base your entire investments on a special fund, they make a great additional investment to complement another index fund. BlackRock. For those wanting to invest in a fund other than the ones provided by Vanguard, You can consider going to BlackRock as your broker. BlackRock has their own versions of popular index funds, often with different fees and possible lower expense ratios. Through their website, https colon slash slash www.blackrock.com/investing slash. You can create an account. Through their iShares service, you can purchase mutual funds, individual stocks, and more. Creating an account involves answering a few questions that helps the website understand your investing style and offers possible portfolio percentages that would apply to you. While you can follow its advice, simply purchasing exclusively index funds would work best for most people. BlackRock's S&P 500 index fund is known by the same name with their code BSPIX. It was created relatively recently, so there isn't much data on how well it performs. The average returns still equal around the 8% mark, making it a viable alternative to Vanguard's services. The best performing BlackRock fund is the Health Sciences Opportunities Fund, a fund investing in the top pharmaceutical companies. SHSSX performs exceptionally well on average, with a whopping 15% average return since its creation in the late 1990s. However, the amazing gains are often set back with negative returns through a few years. The fund's extraordinary performance can be linked to the growing reliance on medicine in the United States, especially because the country's largest demographic is now entering very old age and will be utilizing healthcare more. While this may be an attractive fund to invest in at the current time, it is unpredictable how it will perform after the age of the baby boomers passes. A final BlackRock fund to take note of is the Value Opportunities Fund. This index fund tracks small, up-and-coming companies with the possibility of huge gains. Those benefits come with obvious risk that is paired with investing in small businesses. Most smaller businesses will make a lot of money in a short period of time and then fail. Because of that, the Values Opportunities Fund may not be the best choice for everybody. With an average return of 9%, though, it is definitely a fund to research. The worst it has ever done hovers around the negative 5%, meaning the fund is somewhat of a gamble, even ignoring the 1% expense ratio. Other index opportunities. You aren't limited to buying from the major players that sell index funds. Other sellers, such as Dreyfus, Fidelity, Columbia, Nationwide, Schwab, Mutual of America, Prudential, Shelton, PNC, and more, have their own versions of popular index funds. Comparing returns, expense ratios, and fees for each could possibly be helpful, but we have stuck to two major players in this book because they are generally the best choice. Furthermore, there might be a local trader in your area that you can meet with physically and buy index fund from. Although physical brokers are known for their high fees, so completely understand where each bit of your money is going when you buy from a less reputable seller. Decisively, the market for index funds is immensely diverse, consisting of indexes that follow miscellaneous markets. The two biggest, Vanguard and BlackRock, offer these funds at differing degrees of expenses and with discrete distinction between their specific index formulas. Most every index fund on a popular brokerage website will contain historical data, and that data should be reviewed by you before you make your choice on which funds to buy into. Despite all of this, any index fund following the S&P 500 index is a safe, reliable investment that is virtually guaranteed returns except in the worst market. If the total amount of options is too much to sort through, you can feel safe knowing that investment in the S&P index is both profitable and reliable. How to continue investing. After purchasing one of the funds listed above, the compound interest will begin to work for you. To make accelerated gains, you can add additional funding every month. As we've discussed, it is common to make a 10% contribution to your investing endeavors every paycheck, and that is what you should do. Fill your IRA maximum monthly, and if you have a 401k, especially if employers match your contributions, also fill it. With your 10%, if there's anything left, you can create a standard account and buy low-tax investments. On an online brokerage, navigate to your portfolio and view your investments. For most of the bigger name sites such as Vanguard and BlackRock, you can add additional funds to your mutual fund for usually around $1 each. Continue your contributions for as long as you work. A person under 30 staying true to their index fund will have multi-millions for retirement, depending on how much they put in. At the end of every year, you will have to report your earnings and your income taxes. The process is described briefly here, but remember that the best source for understanding how to file your taxes is a professional. Making a mistake could cost you money and possibly land you in trouble. Taxable investments come as two different types: capital gains and ordinary income. Correctly classifying them is beneficial to you, as capital gains have lower tax rates. Overall, capital gains typically apply to shares, bonds, and mutual funds that are sold. And actually, some index funds held for longer than 12 months can be considered a capital gain, saving immensely on taxes. Ordinary income consists of interest and dividends earned from other investments, and they are taxed within your tax bracket by percentage. When filing, you will categorize your investments by their taxable status. Do not forget that anything going into an IRA or 401k will be tax deferred, meaning you do not have to pay taxes right away. Also, a few government investments, such as municipal bonds, are tax exempt entirely. Other information you will need to specify is the holding period, which is how long you have had a particular asset. Furthermore, you need to know the type of investment you are holding. Finally, knowing your tax bracket will determine how much everything is taxed in general. Refer to the table here and note that the information changes regularly. Income brackets and tax percentages for different investments. Column 1, income range, head of household filing status. Column 2, normal income tax rate. Column 3, capital gains tax rate. Column 1, 0 to $13,250. Column 2, 10%. Column 3, 0%. Column 1, $13,251 to $50,400. Column 2, 15%. Column 3, 0%. Column 1, $50,401 to $130,150. Column 2, 25%. Column 3, 15%. Column 1, $130,151 to $210,800. Column 2, 28%. Column 3, 15%. Column 1, $210,801 to $413,350. Column 2, 33%. Column 3, 15%. Column 1, $413,351 to $441,000. Column 2, 35%. Column 3, 15%. Column 1, $441,000 plus. Column 2, 39.6%. Column 3, 20%. And additionally, there are even higher tax restrictions on the highest income earners. Research P's and PEP tax codes. Definitely use a tax software or professional to help you sort through your taxes if you do not feel comfortable doing them yourself. Finally, after many years of investing and reporting your earnings, you can take the money out of your investment account for retirement. IRAs, 401ks, and other tax-deferred accounts will require you to pay tax at this time, often at the rate specified above, capital gains. However, if you used a Roth IRA, then you would have paid taxes while putting money in, meaning you do not owe any taxes when you withdraw the interest. So basically, the path to millions is simple. Invest in a fund very early and make regular contributions. Compound interest will do the hard work, and when you go into retirement, you will have much more money than what you actually put in. No other work is required besides paying taxes, meaning the knowledge actually required to build a fortune is minimal, and the average person can retire in luxury so long as they make their investments correctly. Investing mistakes. Investing does not have to be as difficult as we've seen. Despite this, there are a few mistakes that early investors can make. Whether they are simply investing in an index fund or they're going higher risk with other types of investments, doing any of the following things can be detrimental to your overall returns. Not investing. Firstly, not investing at all is a very common mistake. Many of the beginners reading right now will finish this book with new knowledge and the power to make money in an easy way. But most of those people will simply not invest at all or put off investing until it's too late. Investing can be seen as free money for those that take the time to tie up their money. Those that choose not to invest are simply missing out on amazing opportunities. Saving money for retirement through a savings account is incredibly difficult and often impossible. Moreover, surviving off of Social Security checks leads to a destitute lifestyle. Most people envision retirement as their golden opportunity to experience new things and travel to foreign places in a way that they could not while working. But without suitable savings gained through investment, living comfortably through retirement is difficult. With a low risk index fund, there's virtually nothing to lose in the long run, so simply not investing is a mistake. Being too cautious, not cautious enough. A few beginner investors try to choose an investment that is either too safe or not safe enough. An investment that is guaranteed safe, such as government bonds or world index funds, have minuscule return rates, but will probably never dip into the negatives. The problem with this, though, as we will explain more in the next section, is that small return rates are obsolete once taxes and inflation are accounted for. Being too cautious is a mistake here, but not being cautious enough is an even larger mistake. Utilities, indexes, or any stock that follows a single entity can be a death sentence when bought individually. Similarly, anything that seems too good to be true with returns most likely can hurt you in time. Striking the perfect balance between hesitation and guarantee is difficult, but not entirely. A simple S&P 500 index fund sits in the sweet spot for risk and reward and is never a mistake to add it to your portfolio, not including taxes, fees, inflation, and calculations. Often overlooked, the taxes, fees, and cost of inflation upon a long-term investment can significantly lower the amount of usable returns. Take $1 million return, for example. If you start investing in the late 1970s and withdrew your million in 2016, 45 years of inflation would have taken its toll. A million in 1970s money would have to be worth 6 million to have the same buying power as your intended withdrawal. Historical data shows that inflation has been anywhere from 10% to 1% per year, with an average of about 3%. This means that you can effectively subtract 3% from your annual expected return rate to find your true returns. Investing is a winning battle against inflation, but just barely. To only truly beat inflation, you'll have to invest a lot of money steadily and steadily beat out the rising price of goods. Consider your final monetary goal at the end of your investing and figure whether it will be enough money that far into the future. A few million now will be worth significantly less decades from now, and this must be always taken into account. Also, subtracting from the total profit of your investments are the fees charged for buying and selling your investments. Fees can differ widely between different brokers, organizations, websites, and funds. Therefore, fees are difficult to calculate for. Understand every fee, including the ones you will have to pay decades into the investment. If you plan to buy index funds, only buy passively managed ones because actively managed funds can have fees in the high percentages. Overall, there are two types of fees to take notice of: fees applied when the funds are withdrawn, and fees applied when the funds are deposited or interest is calculated. The only way to minimize them is to pick a broker or service that charges the lowest rate. Lastly, taxes hurt as well. We've already explained that you will be charged fees on most investments, but it helps just to figure a 20% tax on everything related to investing. Take this off your final amounts during calculations to understand how much money is actually yours and how much the government takes. The mistake that investors make most often is forgetting to account for these three expenses. Most texts, websites, calculators, and brokers fail to explain that your returns are not as high as projected because of inflation, taxes, and fees. Selling too early. Selling stocks when the market changes at a moment's notice is a strategy many investors choose to take. And honestly, when one thinks of a classic investor, that is the image that they imagine. But when shifting to a more conservative investing style, such as highly recommended long term index funds, the selling mentality must be abolished entirely. Long term investments are not designed to be sold when the market increases, and usually there is a penalty applied to those that attempt to do so. Besides this, index funds have an upwards average over many years. If you were to have a fund in the early 2000s, you might have seen negative growth around 2002 and or 2008. But studying the charts would show that the market always returns to an increase over time. Frenzied stock sellers would have sold their entire investments during the market dips, and long-term index fund holders would have come out on top, just as they normally do in lengthy investment situations. Selling too early or emotional selling goes against the investment plan created before beginning investing and can thus lead to lower returns and possible fees. Avoid the beginner mistake of selling your investments too early. Not diversifying. When we stated that index funds are the only investments you will ever need, we are telling the absolute truth. However, the actual index fund that you might buy might make that statement incorrect, such as if you bought an index tracking a single sector. Pledging investors see the large returns that a single sector is making and invest its index without considering the entire industry could pop or correct itself. The dot-com bubble at the turn of the century saw a huge market improvement for internet-related companies. Anybody investing in the early 1990s would have made billions at the height of the growth. But the stocks corrected themselves shortly after, and many people lost money as a result. Diversification would have protected many people's portfolios from the burst, and anyone with an already diversified mutual fund, such as S&P 500, would not have seen such a large hit. Avoid being a classic neophyte and buy into a diversified fund, or at least have multiple sectors under your belt. Conclusion. Armed with the investing knowledge in this book, you can turn small amounts of money into fantastically large amounts with very little effort. The biggest takeaway from this book is to focus on the long-term market as a whole. Funds managed by experts usually always fail to beat the consistent returns of a low-fee index fund over the long term. So all one would need to do to make millions is let compound interest work for them. Thank you for purchasing this publication. In order to actually make your fortune, you absolutely need to get out and invest. What are you waiting for? The sooner you buy into a mutual fund, the sooner compound interest can start earning you money.